It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me, as always, smartest guy in the room, Michael Becker.
Hey, Paul.
Actually, the mayor of Beckerville.
Unofficial title.
Unofficial title. Michael, who has over 5,000 units and has over $100 million worth of investor equity.
Yeah, we just did a deal. It's cracked the $100 million mark of capital raise. It's pretty unbelievable, starting only 4 or 5 years ago.
That's unbelievable. But Michael, who's been a long-time banker for one of the largest national banks, knows his stuff. There's no doubt about that. And talking about knowing his stuff, he joined us on the panel at the Old Capital Multifamily Conference held in October the 5th. What'd you think about that conference, Mike?
That was great. We had, over 450 people actually show up. I can't believe we had that many people show up from all over the country. So we really appreciate all the listeners and everyone coming out. And it was very impressive to meet people from both coasts and California and Maryland and Chicago, to fly to Dallas, Texas to hear a couple guys like Paul and Mike talk on stage. I thought it was pretty amazing. Yeah, that was an all-day conference, and I think a lot of people they learned a lot, and so we were appreciative for people making the effort to come to Texas, to kind of understand a little bit about what's going on in Texas, not just in Texas, but all throughout the United States concerning multifamily. So Michael held the panel that had a number of listing agents. So I think that listing agent panel that you were on had, 5, 6 people? Yeah, so what I think we're going to play here is kind of part one. We'll play next week part two of a panel that I hosted, I moderated. And we had 5 of the top apartment brokers in town that probably control, 70+% of the deal flow in DFW was up on that stage represented for the guys and their firms. So we had Al Silva out of Fort Worth with Marcus Millchap. We had Nick Fluellen out of Dallas and Marcus Millchap. Chris Douillet with CBRE. Had Jacob Anderson with ARA and Mike Birch with Rowan Properties. So those 5 guys probably control, their firms control about 70% of the deal flow in town. So we really just kind of went through and talked to, asked each one of these guys one question. So we talked to Al about the state of the market in the city of Fort Worth. Talked to Chris about the city of Carrollton, how he does kind of a market analysis and used Carrollton as an example. Jacob talked about portfolio sales. Nick talked about getting deals done off market, and Mike just kind of talked about the life cycle of a transaction. So we thought it turned out really well. These guys have a lot of depth of knowledge, and they probably collectively, their firms probably do almost $2 billion a year in sales. So these are the guys that know what's going on, and they control a lot of the market. So if you don't want to listen to these guys, you don't want to do business. That's for sure. Yeah, the depth of knowledge was unbelievable at that table. Just picture in your mind's eye, so you have 5 or 6 guys up on stage with Michael, and we had 450 plus, 475 in the audience. Just a great dynamic crowd. And again, we broke this up to 2 different podcasts. So the one is for about 38 minutes. The second one's going to be for about 30 some minutes or so. So you'll enjoy it. So the second one will be next week. So hopefully you enjoy that. Michael, if somebody wanted to reach out and kind of figure out what the heck you do, tell us a little bit about how they get in contact with you. Yeah, really the easiest way to do that is go to my company's website, which is www.spiadvisory.com. That's SPI like spy advisory.com. And just send a contact us page and send us a quick email. And happy to, start a conversation with anybody that reaches out through the podcast. That's great. So again, this conference, it was October 5th, so the data and the information is pretty much up to date and correct. So please listen and let's get it going. So these are the players in town that do a lot of volume, or amongst them up here. So I thought I would just kind of go down the row here, starting with Nick, and maybe Nick, you could do a quick little introduction on yourself and tell the crowd who you are and what you do.
Sure. Nick Fluellen, Marcus Millchap here in the Dallas office. We have a 12-person team focused primarily on Class B and Class C assets, and we also are covering secondary and tertiary markets, and also have guys focused on investors who are doing smaller deals as they're first learning and getting into the business. So we really try to cover the entire sector, and yeah, that's it. I've been with Marcus since 2004, so glad to be here. This is a great event, and I look forward to networking throughout the day.
My name is Chris Douillet. I'm with CBRE. I grew up here in Dallas. I'm a DISD product, so I've kind of seen how Dallas has grown and ebbed and flowed. I'm part of a 6-man team where we've got 2 that handle the A product, 2 that handle the B product, and myself and Chandler Sims really handled more of the BC product. So been doing it since 2000. So
Mike Birch, Rowan Properties. We've had the Rowan flag for about 4 years. Personally, I've been in the business since the middle 80s, so I got to see one of the worst real estate markets, and today is probably the best real estate market I've ever seen. So we're all over that B and C space, and again, glad to be here.
Hi, Al Silva with Marcus & Millichap. I'm based out of the Fort Worth office, focused on B and C apartments throughout the DFW Metroplex. Been with the company for almost 14 years now, since 2004. Nick and I came up in the business together from the beginning, so it's been an exciting run thus far. Spent my first 5 years with the company out of the Dallas office, and spent the last 9 years or so out of the Fort Worth office. So it's been exciting seeing the ups and downs in the market and being heavily involved on both sides of the Metroplex. So excited to be here and excited to be a part of the event and to see everybody here. So thank you for having me.
Hello and good morning. My name is Jacob Anderson. I'm with ARA Newmark right down the street. We are a 9-person team. We exclusively focus on multifamily. We do from the C's, the D's, up to the big A's, and we also do land. I've been in brokerage since 2012. My background is in development as well and asset management. And thank you so much for listening to us.
So let's keep it with you, Jacob. So you and your firm ARA sold numerous portfolios over the years. Maybe you can kind of talk through a little bit of the differences between selling a one-off property versus selling a portfolio and kind of the pros and cons of each.
Sure. I got the honor of talking about a little bit of the difference here today of selling a portfolio versus just the individual deals. The way I elected to break it down is kind of the pros and cons approach via SWOT analysis. So you have got strengths, weaknesses, opportunities, and threats. So to start with, the strength of doing a portfolio sale is, the main thing is economy of scale. And I think that goes for both parts of the transaction. You have sellers out there that likes to just do one transaction, taking it out and focus on it kind of in one moment in time. And you also got buyers that are looking for, that bigger asset. And as a couple of sub points there, when you're raising equity, you can raise equity on $1 million deal, and you can raise equity on a $100 million deal, depending on where you are in the cycle and what you're looking for. You got more and more guys looking for bigger chunks. So it's the same work that's attached to it, and they're just looking to put more equity out there in one setting. The other thing is lower transaction costs. And that can be an internal factor if you're a bigger company, or it's just yourself. Your time is valuable when you're looking at stuff. So if you can do multiple deals at the same time, you can use your attorney and just use one contract and get it done. You save on that aspect of it. Increased operational efficiencies. When you're looking now to the left, you have a portfolio of 800 plus units in Lubbock, Texas. So when you go out of the bigger markets, it makes a lot of sense when you're looking for your vendors and in controlling your expense side to get 800 units instead of just 200 units. The next one is sophisticated buyers. Everything is relative, but I think there is a perception out there. If you're dealing with a $5 million deal or a $20 million deal, you typically attract a bit more sophistication, so there's a perceived notion it's going to be an easier transaction on the sales side. Premium values, that's a tricky one because there's always two sides to the medal there. When you're selling, you will be able to maximize values on one asset as a part of their portfolio you might not have gotten the same value out of if it was just by itself. On the flip side, you can look at it from a buyer's mentality. Now you're getting that dog out there, you might not want it. So it goes both ways. Shifting over to the weaknesses, sometimes it can get too large. We have over here, as an example, the Plano portfolio. It was 2 deals. It made a lot of sense to put them out together. One is smaller. We did have a lot of interest in the smaller one. It was a perfect fit for a lot of guys with 1031 funds. They just couldn't do both. Ultimately, it went as a portfolio, and that way we did alienate, by taking them out together, some buyers that I'm sure would have performed just great. Opportunity, I know that's next. New to market, yeah. So if you're new to market, you're coming into Dallas-Fort Worth, you don't own deals, you have owned in other markets. You want to get a footprint. You all know it can be tough to get started. Here you have an opportunity sometimes to go in and grab multiple deals at the same time. You can justify your management, you can justify your asset management, regionals, whatnot, and get the attention you need. Good pricing. Sometimes you also, when you're buying a portfolio, the seller is looking for an easy transaction. They're choosing your offer because they want to just deal with one guy across all the deals. As a part of that, you might pick one up that's got a great location and a ton of upside for a discount. So that's kind of the counter argument to the first one. As a seller, that's a good thing for a buyer. So that kind of goes both ways. And lastly, when you're looking at threats, we didn't put it up here, but we have a portfolio right now we have in the market. It's 4 deals. We have 2 down in San Antonio, 1 in Dallas, and 1 in Houston. Now, a scenario like that, it's going to be tough to attract a buyer that would like to take all of them due to the facts what has happened in Houston here the last month. So it's going to be important for the seller to be flexible with their approach and look at, hey, we might not get in this scenario the same buyer for all the asset, but we'll kind of peel them off in different directions. So as a buyer buying those, let's say it was a month before the hurricane hit, now you're sitting with one asset, you might have just one contract on all of it, and what are you going to do? So that's really the threat when you're looking at multiple locations, multiple assets, and a lot of moving parts. So that's it.
Perfect. Anyone else on the panel have anything to add on a portfolio sale before we do? I know everyone else up here has done portfolio sales as well. Nick, you have one on the market now, I believe, right?
And we do. We have the North Dallas value add portfolio, and I agree with what Jacob said. I mean, there's certainly a pool of buyers who want to take down $95 million worth of product all at once, but for a lot of the folks in this room, a lot of those individual assets are very appealing. And so I think in our scenario, we're going to get offers for both. It's very important everybody, puts the value that they have allocated to each asset and whether they would take 1 or 2 instead of the whole thing. And we're going to look, but there's a lot of moving parts, no question. And it's a more complicated execution. It can be a very simple execution if you have one buyer, but otherwise you may be dealing with 2 or 3 buyers and 2 or 3 contracts and different timelines and all that. So yeah, I mean, definitely pros and cons.
So, Chris, there's been great submarkets around the country, and DFW is no different than that. And one of the ones I know you sold a lot of property over the last several years. My hometown, Carrollton, Texas, Carrollton Farmers Branch submarket, around the corner from where we sit right now. Can you maybe kind of give a quick market overview of Carrollton Farmers Branch? Maybe kind of explain to everyone here that maybe is a little newer why, through the description of the Carrollton Farmers Branch submarket, what makes a good market in your estimation, and what are some of the key drivers that you look for when trying to if you were a buyer trying to select a submarket?
Sure, and the graph's up there. So what we usually do, what you're seeing up there is when we analyze a deal per se. So a lot of this stuff can go into our marketing package. This is what we research and we look at the submarket. Hey, what's the potential? And we actually, it was interesting, Mike, you said, hey, Chris, pick a submarket, and I went ahead and picked this one. A lot of the guys on the panel, including myself, we've sold a lot of deals up and down Josie Lane, Fox Creek, Cooks Creek. So many of you guys have probably toured it, underwritten these deals, looked at it, maybe sold it, bought it, that kind of stuff. So you're real familiar with that particular submarket. But looking at a little bit on this one, the infrastructure for Carrollton Farmers Branch, there's roughly 150,000 people. So you could chime into Amy's comment, we're adding 150,000 people a year. We're adding a Carrollton Farmers Branch each year instead of McKinney. But so the infrastructure, what you're seeing there with Carrollton Farmers Branch, obviously I-35 is being widened. It goes down to 635, going west towards the airport. And then you're seeing also a lot of new development right now. Vitruvian is a 126-acre development site just west of Carrollton Farmers Branch, but that's driving job growth. And then also Mercer Crossing, a 700-square-foot industrial warehouse facility. You can probably see it right along 635. That's sparking new interest. And then Carrollton Farmers Branch, as Amy had chimed in, it's all about population growth, all about job growth and the proximity to it. If you live in Carrollton Farmers Branch, you literally are 20 minutes from about 300,000 jobs. And that's a big driver. You've got Las Colinas and Addison right there. So if you look at the statistics a little bit here, the people in Carrollton and Farmers Branch, they work. Their unemployment rate is lower than the rest of Texas, yet If you look in more of the B and C product, the average occupancy is very tight at 95.5%, well above the Texas average, as well as the rent growth, household income. These people they're well off and they want to live there. The other thing that we look at, I say that to say this, is that now that that's all kind of occurred, developers are kind of interested in the area. So you have approximately 21 properties that are either planned or being developed in that area. 6 of them are being built. They put the slabs down and everything, and they're finding that extra land inside the city limits to build. So there's really just 2 that are concentrated kind of in downtown Carrollton, but then everything else is very much close to the main arteries, 635, 35, for commuters. So that's a very strong interest. Now looking a little more on the chart, what that's doing is on the lower left-hand corner, what I always hear for years is with B&C product is, hey, how come your occupancy's dipped? Why is it dipping? And there's always reasons, but there's always one that always seems to uncover it. They went and got their first house. They went and bought a starter home. But if somebody, other than being promoted or having to move away for their job, the delta in the lower left-hand corner between the average rent and the average homeowner, principal, interest, taxes, and insurance, the difference is significant. So if somebody wants to rent and they go, well, I want to buy a house in Carrollton Farmers Branch, they really can't. So they're kind of locked in. So that removes that issue or reason why they would move out. The other observation, and I think this is, even with the new development coming on in the submarket, if you look at those 3 horizontal lines, hopefully you guys can see that in the back. The top is the average A rent, then B rent, and C rent. The difference between the A and the B rent is 43%. So even if, let's say, we overbuild, the 50,000 units coming online, that's always thrown around. If there's a reason why we overbuild and the Class A product has to give away a concession, let's say 1 month's move in, 6 weeks, 2 months, the difference between the A rent and the B rent is still big enough that what you're not going to have is what we call resident creep, where somebody's living in a mid-'80s vintage, they go, you know what, I can still afford and move into a nice A-class deal, 9-foot ceilings, maybe common area Wi-Fi, I've got a lot more amenities, maybe better schools, things like that. But in Carrollton Farmers Branch, they can't do that. They will stay in that B product. And the same thing goes for B and C product. That difference is 38%. You're not going to have somebody that's living in an early 70s vintage going, well, maybe I can move up to a mid-80s vintage. They just will have to pay a lot more, and they usually don't want to because they're very income constrained. So that's how we kind of analyze a deal, a submarket. So if we're analyzing or putting a property on the market, we make sure that some of this material is in our marketing packages to show that example. So that's just an example. And then you had also mentioned, what other submarkets, and Amy had touched on this. Some of the areas that, if we talk about, McKinney, Frisco, Allen, all that kind of thing, but there's some other pockets, I would say, in the Dallas-Fort Worth area. It ebbs and flows, but in the next 5 or 10 years, if you invest in that area, even with the B and C product that's already there, that would be over in West Dallas. There's some older vintage deals over on the other side of the Margaret Hunt Hill Bridge, also known as Large Marge. If you get in that area, the older product, and spruce it up, you will recapture your investment significantly. And then the other area would be, people talk about Denton, but the west side of Denton. If even west of 35, you have Razor Ranch, a massive redevelopment there. You have a Sam's and a Costco and Chili's and all that's already occurring. But what the state is doing is they've widened I-35. They've also widened 380 that goes east and west through there. And then Loop 288 is going to continue on the west side of 35. And that's going to be completed in 2025. That's going to spur all that new development. And so properties that are over there already established, you're going to have that same kind of potential that you can fix those properties up and really reap your investment. So those are 2 areas that I think not a lot of people talk about. We've sold 2 deals in Denton proper, but then we've also sold a deal in Crum, Texas, and that's just kind of on the outskirts. And I would say nobody's heard of Crum, but if I said, hey, has anybody heard of Wiley and Saxe and Prosper 10 years ago, you might not have heard of those. So I think this is kind of an up-and-coming area that's below the radar screen, in my opinion.
All right. Thanks, Chris. So Mike, as you mentioned, you've been in the business since, the early 80s? Is that right? So you're the senior member?
Mid-80s.
Yeah, mid-80s.
Mid-80s.
So he's a senior member of the panel up here. So you probably have been involved in more transactions than pretty much anyone else up here. Maybe you can kind of talk through a transaction. You have an example of one that you've done. So maybe you kind of run through it, tell us why the seller listed the deal, why you chose the buyer that you ultimately chose, what were some of the differentiating factors. A lot of people here are either aspiring or have done a deal. So what from a broker's perspective gets you the listing, why you were chosen, and then why do you ultimately choose a potential buyer when they're bidding on it? Because it's a pretty competitive market, as we all know. So what are some of the things that differentiate one buyer over the next?
Well, thanks. What we did is we just picked a property, and I'll kind of walk you through the process there. The property, it's Wellington on the lake. It's in Wichita Falls. Now, why did we pick Wichita Falls? Well, no reason in particular other than it's a tertiary market. Thought it might create a little more interest than the typical deals that you're seeing in Dallas and Fort Worth. So the one thing that we did in the marketing part, well, let me back up. This was a relationship listing from somebody we'd done a lot of business with. But when we went to market, typically you're seeing these marketing packages, and almost all of them are unpriced. So in this particular case, there was a list price. The list price was $12.7 million. It's 208 units. You can do the math. Built in 1998. Gives you an idea of what values are outside of Dallas. Everybody's looking for deals. Nobody woke up this morning and goes, wow, I'd love to be in Wichita Falls. We get that. But you are looking for opportunities, and this is a good example of how that worked. At the end of the day, this deal sold for about a 6.3% cap rate. The fact that we marketed it with a price, with a listing price, we actually had a better than we thought response. Typically what happens is the buyers wait until the very end. You go through the bid process. It's a lengthy process. All of you have been through that. But in this particular case, the buyer stepped up quickly. And that's what won the deal. That was the overwhelming deciding factor. That and the fact that he paid a high price. So that's how that happened.
So that one was on price, but maybe another transaction. What are some of the things that you're seeing that differentiates one buyer pool versus the next when you have pretty competitive pricing out there? What are some of the things you see in the contract, or what are some of the ways that a potential buyer can approach you as a broker to gain some credibility to get over the hump if they're relatively inexperienced?
Yeah, so everybody, as brokers, we're always trying to qualify buyers. We're asking you all the qualifying questions. How many deals do you own? Who's your lender? How much is the equity raised? All of those kind of things. So the fact that you can disclose that to your broker is absolutely going to help you. He's got to be able to convey that information to the seller so that the seller can make a decision. And the fact is, if you've got everything lined up, you've got a big head start. You hear about hard money day one. It's not something everybody's willing to do, but you're seeing it. That, short contingency periods, to me, those are the overwhelming factors.
So as a broker, and all of this up to the panel, so what I heard Mike say is certainty of execution is utmost importance, right next to price and terms. Anybody have anything else to add to that kind of general theme?
I mean, those are obviously important. What I would say maybe as a second tier is have your ducks lined up in a row. So if you're going to use third-party management company, hey, let's get a debt quote. Hey, where's my equity coming from? How liquid am I? All that kind of stuff that if you can provide with your offering up front, that helps establish you a lot more, especially if you're a first-time buyer or have been a passive investor for a while and you're finally stepping up to be a KP.
Yeah, something I'll add to that, what Mike mentioned and what Chris mentioned, all the most important things, which are, price, terms, and then having all your ducks in a row, having your business model lined up. But those are all tangible things. I think there are also intangible things, such as, having an enthusiastic business plan for the acquisition and being able to effectively communicate that to the broker and to the seller. Doing things like that because you're looking at an offer matrix, you're looking at price terms, who are their vendors and so on and so forth. And that's all very necessary, but you're looking in a very competitive market for ways to differentiate yourself. And I think, having kind of that story, selling the sizzle to the seller instead of the seller selling the sizzle to you, doing a little return selling goes a long way in a competitive market.
So that might be a little counterintuitive. A lot of people think if I crap on the deal and point out everything wrong with it, maybe I could beat the seller down on price, but that's not the case, right, Nick?
10 years ago, that worked.
Yeah, but I would just add, just as everybody here is looking for strategies to figure out where's that little thing that I can do to win the deal. I mean, I 100% agree with all these things, but having your contractor walk the deal while it's on the market, go out there with your contractor, get an extensive budget. Taxes are making and breaking deals right now, as all of you know, especially in the last 2 years. I mean, Tarrant County has been brutal on taxes. Dallas County had been a whole lot better. Hopefully that's going to let up a little, but get a tax consultant to look at the deal on the front end and say, hey, I think based on uniform and equal and the income approach here, I think they're going to fall in 82% instead of just plugging in 90% or 85%. If you can convey that to a seller, then all of a sudden you've got an advantage that maybe everybody else doesn't have because they just use 90% or 95% as a placeholder. So I think all those little details, they not only help you in your underwriting, but they also show the seller that, hey, I've dug into this. I'm not just throwing some numbers in a spreadsheet here and rinse and repeat. Every deal I look at, every deal is unique and every set of circumstances is unique. And so to the extent that you can convey this deal's important to me and I've gone above and beyond and I've gone the extra mile and here's what I've done and I've had my contractor out, my management company out, I've consulted with a property tax, my lenders walked the deal, I'm ready. I mean, you've got a much better chance. And there are people in this room that we've transacted with that probably were the underdog just on paper, if you saw who they were going up against and ended up winning the deal. So, I think anybody in here is capable of winning those deals with just going a little bit above and beyond.
It's good stuff. So, Nick, keeping with you, speaking of deals, elusive thing out in the marketplace is the off-market transaction. A few years ago, you guys didn't do a whole lot of that, but over the last year or two, you've seemingly done quite a few deals off market. Maybe you kind of talk through first, why would a seller sell a deal off market? And then on the flip side, how can a potential buyer position themselves to be awarded a deal off market? What makes these deals happen?
Yeah, I think that's a great question, and obviously that's what everybody wants to know the answer to, I'm sure. You're exactly right. A couple years ago, I would say maybe we do one or two of these a year, and I didn't count before today, but I'm guessing when the year's all said and done, we may do 15 this year alone. And so, first of all, let's talk about it from the seller's mindset. A number of sellers, as all of you underwrite your deal, you all have your reversion cap rate, you all have your projected exit price, and so I think that with the market, there's everybody looks like they're really smart right now because of the way the values have gone. If you bought a deal 5 years ago, you probably look like a genius right now. And these values are so far and above what most people looked at as their potential exit. So in many cases, the seller is saying, hey, I'm knocking the cover off the ball with this offer, and if I can get to this, then I'm happy. I think that there's a number of sellers that don't want to go through having 30 different groups, out disrupting their operations and the strain that puts on their management and having to worry about managers leaving and maintenance guys leaving, looking for a job. There's challenges. It's not easy to sell a deal. So I think there are sellers who, if I can get my number and be done, and then I'd be happy. And so they're out there. It does seem a little unusual in this market right now, which, as Mike said, is probably the greatest market that we've ever experienced here. That you wouldn't want to go to market and get 15 offers and see where you shook out, but they're out there. So then on the flip side, how do you pick a buyer and how do you be positioned for the buyer, to be the buyer for that? And it's a relationship business. It's from our standpoint as brokers, we'd all tell you, when we do come across a real off-market opportunity, there's a pretty good chance that we get one opportunity to get somebody in there. Right. The whole reason it's an off-market opportunity is because you don't want to go through the process as a seller 3 or 4 times. You don't want a bunch of disruption. So if we pick the wrong buyer, odds are we've cost ourselves a fee and we've potentially harmed the relationship with the seller. So the certainty of execution is an absolute must. And so certainty of execution, if we don't know you and we haven't done a deal with you, we don't know who your equity is, we don't know what your balance sheet looks like, you don't own any other deals, I mean, honestly, you're not likely to be the person right now awarded an off-market deal. If we have transacted with you, if you have done all these things that we've talked about before, even if we haven't transacted with you, but we know you're a real buyer, and your terms are aggressive. And one other term I didn't mention, but I think this is becoming more and more critical as a deciding factor, is how quickly can your attorney turn a contract? We don't want to waste a week to get a red line contract back, right? So are we responsive? But all of those things, maybe you own in the submarket, and so you're the logical buyer to call for a deal like this. Maybe you're the person who has called us, once every 2 weeks for the last year, and so I know exactly what you want, and it's top of mind, and sometimes the squeaky wheel gets the grease. I mean, it really is true. So, but I mean, the bottom line is we need a buyer, candidly, that's going to make us look good, that's not going to mess around with retrading, that's going to go hard. There are no off-market deals that happen without a lot of hard money. So I know that does make people uncomfortable, but it's, if you're not willing to go hard, somebody else is willing to go hard, day one. And I know it's not the market everybody, or it's not the term everybody wishes that it was, but it's reality. We have a deal this week that the buyer's going hard with $600,000 day one on a $20 million deal. So, I mean, that's what it took to win it, because the next best buyer was 500. So I think those are all factors, but I just, we need to build relationships with all of you in here who are ready to take that next step and who want to be in the queue, and build that confidence that if I am able to get you the right deal, that it's a done deal.
It's a lot of money. $600,000.
$600,000. I wish all of them were like that, but that's unusual. I will say that, but I've never, they're
going to close.
They're going to close, right? I mean, they're going to close. So, and the seller's not going to be probably that mad at me if they don't close, because they'll have $600,000 in their pocket. So
that's good. Well, we'll touch on some more of these points after this. We want to get to Al. So Amy mentioned it. When a lot of people think of Dallas-Fort Worth, they think of the Dallas side. It's where the preponderance of the new supply is being delivered on the Dallas County side, not so much the Tarrant County side. You're the only major broker in town that I'm aware of that's based out of Fort Worth, Dallas. You may have a different perspective of it. Amy's bullish on Fort Worth. I'm personally bullish on the Tarrant County, Fort Worth. Last 4 or 5 deals we've done have all been in Tarrant County. Continue to look that way for many of the reasons why Amy mentioned. Maybe you kind of give your thoughts on the pros and cons on the Fort Worth side over the Dallas side, or Tarrant County more specifically than Dallas County. I mean, what do you see kind of going forward, and what's the state of the market on the western side of town?
Yeah, sure. Thanks. So Fort Worth's near and dear to my heart. I was born and raised there, and when I was growing up in Fort Worth, if you go back 30 years ago, there were maybe 425,000 people there. It was known as kind of a blue-collar suburb, or stepchild of Dallas, depending on where you were from. And historically, it's been known as being more tied to oil and gas and not having as diversified of an economic base. Just a number of different factors. Well, if you fast forward to around the year 2000, you're up to 650,000 population. Today we're approaching 900,000 in population in Fort Worth. So we're not a small market anymore. And I think. Another thing that was another notch in Fort Worth's belt was when we had the oil and gas downturn a few years ago. When that began, everybody was expecting, Fort Worth to suffer like Houston was suffering. But Fort Worth didn't skip a beat. We didn't have employment losses. We had a few mom and pop oil and gas companies leave downtown. But really, overall, it remained very healthy. And I think that put it on a lot of people's radar screens, because I think Amy hit on it during her State of the Market presentation. We've seen just incredible, breakneck growth. And I think the high-level thing to remember about Fort Worth is that we have all the metrics that people love about Dallas. When you talk about population growth, employment growth, diversification of the economy, proximity to DFW airport and getting to other parts of the country. And so we've got all those things. And actually, on a percentage basis, we've been growing faster for the last 3 or 4 years than Dallas has. Of course, Dallas adds more jobs and adds more people on a numbers basis, but percentage-wise, Fort Worth's been actually growing faster. And so that's a real story. You've got the whole Dallas story, but without the name Dallas. But you have to look at it as one big market. But I think one of the most compelling things about the Fort Worth market right now as Amy mentioned, is the lack of overbuilding. People fear overbuilding Dallas-Fort Worth and Texas in general. We're known for overbuilding here in up cycles, but in Fort Worth, out of the 50,000 units that are in the construction pipeline, we've got around 5,000 of those. And if you look at Fort Worth as a percentage of the population, about 1/6 of the Metroplex, we've got less than 1/10, or right around 1/10 of the construction pipeline. And so when you look at occupancy, when you look at rents, apartment fundamentals, it's based on supply and demand at the end of the day. And when you're building fewer units and adding more people, that puts upward pressure on occupancy and rents. And that creates a really healthy market environment for Fort Worth. And so, for the last 3 years, Fort Worth's averaged about 2.5% population growth on average. Dallas has been about 1.6%. And so, you can see, as I mentioned, the numbers there. And from an employment standpoint, those numbers are pretty similar. You don't have the huge headlines of, State Farm moving their headquarters to Fort Worth like you do Plano, but quietly we are adding technically more jobs on the western side of the Metroplex. And so as a result of that, as I mentioned, it puts upward pressure on rents, which, they're up over 6% so far in 2017. Versus Dallas, we're kind of in the mid-4s on rent growth in 2017. A lot of that has to do with the amount of new supply that's coming online in Dallas. So that's another compelling reason, to look at Fort Worth as a great investment market. And I think Chris was hitting on some of this when it came to Carrollton and Farmers Branch. I think a lot of those drivers he was referring to, like proximity to job centers and proximity to other parts of the Metroplex where you can get to them easily, that's leading the pack in rent growth in Tarrant County. So Arlington, 8% rent growth year over year, which is incredible. And that's because of that proximity. You can get virtually anywhere in DFW from Arlington very quickly. East Fort Worth is literally right next door to Arlington, so similar concept there. Hurst Euless Bedford up 7%, East Fort Worth, as I mentioned, and then Hurst Euless Bedford. So those kind of centrally located submarkets are the ones experiencing the fastest rent growth, which is exciting. So transaction volume as a result in Fort Worth has grown tremendously. When I relocated to the Fort Worth office 10 years ago, there wasn't a lot of deal volume going on. It was like San Antonio is today almost. It's a big market, but nobody really looked at it from an investment standpoint. And that's completely changed today. When you put a deal on the market in Fort Worth, 200 units built in the 80s in Fort Worth versus in Dallas, you're getting the same number of tours, the same number of offers, and the same level of activity. It was not like that 10 years ago. But, there are a lot of attractive things, all these things. The cons, as Nick mentioned, is the property taxes. They've been extremely aggressive in terms of reassessing people and just throwing values out there. And so that's been the biggest challenge of owning apartments in Fort Worth is having to deal with the tax authorities. I always joke that they have people cleaning tomatoes off of the appraisal board every morning. And I think overall that kind of summarizes it, Mike. A lot of pros, very few cons. So any more information you want to know, let me know.